Well, Investment Solutions investment team recently visited some 30 fund managers in Europe and the US. And these are managers across asset classes. To discuss the key findings, we have Linda van Tonder, who's the head of global products from Investment Solutions. So quite a rigorous road trip that you've just been on, Linda. Is the end result net positive or net negative in terms of what you're seeing amongst offshore fund managers?
I would say the end result was very much net positive, a bit of a change that we've seen 2 years ago, just after the credit crisis, traveling offshore and experiencing that vibe. Managers are in good space. Active managers just had a very good 2014 or 13 of outperformance. They're recruiting, they train their analysts on graduate programs, so very much positive vibe overseas.
Well, gentlemen, this is your chance to find out what the offshore teams are doing. So let's hear where you want to go with the discussion.
One of the observations you made was that South African rooted managers or managers that could be traced back to South Africa are doing particularly well. Can you attribute that to anything specifically? What is it that they're getting right?
So just to put Adrian's comment into perspective, we look at a survey called Morningstar. It's a database with thousands of active manager returns on it. And when we look at a global equity category, our global equity fund is top 20%, but so is a fund like Orbis, Old Mutual, Investec. The South African managers really have done well. I put Foot in that category too. If I can attribute anything to that, myself having worked in London at some stage, I think we're much more practical, pragmatic approach. We take on a much more global perspective on things, where I think maybe I'll show you a little bit in your box. But it's very hard to know why South Africans have had such a good stock picking environment.
One of the other themes that comes across clearly is that emerging markets are not delivering what offshore managers initially thought they would continue to deliver. And that goes to the argument we're having on the desk at the moment regularly, developed versus emerging. Is the emerging story over? Emerging market story over?
We discuss it internally so often, and I do like watching your program, and it keeps coming up. So the emerging
say that
story,
again.
the emerging story is definitely not dead. But what we found very interesting is that we've went out and met asset managers who have both a global equity fund but also a global emerging market fund. So they have a specialist team just looking at emerging markets. That universe is vast. So we would expect their global equity fund to be piled with emerging market stocks. It is very interesting to see that those managers are sitting at about 8% on average in emerging markets, whereas your index, the MSCI All Country World Index, is sitting at 12%. So we are finding outliers like Orbis at 15%, but generally managers are underweight, and we think it may be a home bias or a developed market bias that managers have.
Inside of those emerging markets, are there specific emerging markets that they're staying away from to cause that underweight position, or is it broadly across the board underweight emerging markets?
I would say those managers that have specialist teams, large analysts that can look at any country, doesn't exclude any country from their list of countries that they like to invest in. A country like China used to be very hard to invest in, very difficult with their transparency, but it's become better. So yes, some managers say we don't like to invest in India, we don't like to invest in Russia, but across the board we're finding that stocks are coming from all countries.
Hello?
From a pension fund standpoint, from a liability-driven standpoint, pension funds are still still in deficit. Do you find that the industry is able to meet those return requirements that pension funds are forecasting for their members going into the future?
I mean, the DC debate's probably a bit of an easier one, because what you put in is what you get out, whereas I think on the DB side is what we're seeing offshore. So a lot of DB funds are struggling to match their assets with their liability. And I guess it comes back to how do you model or how do you forecast and what is your expectations? I think it's the expectations that's a difficulty, not the investment returns coming. So will there be returns? Yes. I mean, in fact, a lot of absolute return strategies coming to the fore where they want to give their members absolute returns. But if your expectations are going to be too high, especially with the younger generation like us who've just seen a bull market, then you will be disappointed.
Linda, one of the other themes you picked up is that those managers that are excessively bearish are losing assets, they're losing staff. I don't want to categorize them as growth or value, momentum, whatever it may be. How do you define that trend, and what is their downfall?
I think you can categorize them as defensive or like excessively bearish managers. It's definitely not a growth or a value style. And we find that very challenged. Chris Hart, my colleague, has said, you've got those managers who will make it to the bubble, and then you get the managers who will make it through the bubble. We've seen a lot of managers making it to the bubble. Good example is Vantage, one of the funds we invest in, Andrew Veglio. excellent 20-year track record, giving you great protection in 2008. But what happens after 2008? Do you stick to your view? Because we all see the problems out there. I can't argue with these comments. But if you're excessively bearish, the markets are not rewarding that, and that's what in the end is going to get you through the bubble. But we really sincerely hope that those managers do make it through, because that's when you'll need them, and that's where you want those managers to survive, to give you that insurance policy.
Adrian, let's come back to you here.
Yeah, I suppose it just bears testament to the observation that the market can stay irrational longer than many investors can remain solvent. It's not. It wasn't just equity managers that you made reference to. Bonds has been a tough environment, I would imagine.
I think the difference between the two is where 2 years ago equity managers were in a bad space, underperforming the index by 10%, 20%. It was not uncommon, where I guess we've seen that now in the local market in the past year. Whereas in 2013, they're giving you alpha or outperformance of 20%. I mean, that's exceptional, and they've just stuck to their bets. Whereas in the bond market, you're absolutely right. Those managers have not had a great year, especially after June when the Fed made their comment. We've heard a lot of good quality managers said, I turned my portfolio around. I had to clean it out because the Fed just came with their comments and I just couldn't give my investors those returns. I just couldn't prepare myself for it.
Lilo?
When you take stock of how well managers are doing out there, and you look at how the S&P is at its all-time highs, what does Investment Solutions sit with regard to our proximity to the bubble?
We are very cautious, very worried, but I guess I feel very fortunate that I'm not in your shoes or direct asset managers, because we have the privilege to see, I've got a view on this side, I can see the bubble, I can see why you're conservative, but I'm very happy for another manager to be, I'm very cautious, but I'm going to be optimistic and be 60 to 80% in equities, because our privilege is combining those two and making sure we make it through these cycles and not place all our bets on one asset manager or one view.
Linda?